macros are going to look like in 2025? A lot of moving parts out there, but who better than Maneesh Dangi to help us understand how exactly this jigsaw is going to look like for the year ahead? Maneesh, hi, good to have you, and New Year greetings from all of us here.
Hi, Asha. Happy New Year to all of you.
Right. So, Manish, tell me, is it going to be as happy in the year ahead or not? Because the macros definitely have gotten wobbly. Some of it is already in the price in the year gone by. But what's lined up ahead?
I guess in 2024, the macro sort of evolved uh, surprisingly that US continued to stay strong, but India certainly sort of weakened a lot more than what most of us anticipated. And I guess since these growth trends to sort of last for longer than 6 8 months, it's more likely than not that India would continue to sort of stay in a slow lane. Uh, at some point in time, hopefully, US slows and then gives us breathing space to cut rates and ease regulatory environment, and of course, that perhaps would put a floor to the growth slowdown. So I guess 2025 will perhaps not see acceleration in growth slowdown, but more of the same of 2024 would likely continue. That's how I kind of think of how macro would evolve.
Okay, so that's a take coming in as far as the macro setup is concerned. But one of the biggest challenges per se, or biggest important things to watch out for at the end of this year has been the kind of dollar strength that we have seen. I mean, 108.5 thereabouts. What happens to that? Because that clearly has a big impact, whether it is flows, whether it's rupee, whether it's a lot of those domino effects.
Yeah, so in a sense, it is born of the fact that US didn't slow, and therefore US Treasuries, especially after the Trump's sort of winning, have risen again quite dramatically, and so there's a clear wedge between uh, a high US Treasuries and on the other side, let's say what has happened to China rates. Rates have plummeted dramatically. It's at 160, 170 now on 10-year bond. So this wedge actually opens up, situation in which dollar continues to strengthen. Now, as I said, right, that until US slows, US treasuries cool off, and then US dollar actually weakens, the the financial conditions will continue to tighten across rest of the world. So your question, of course, is that what happens? Tight dollar, of course, means tight financial conditions, and that essentially means that the emerging markets, more specifically, don't do well, both equities and bond. In India's case, because our CAD and inflation are in control, we still had bonds rally a bit. That hasn't happened to many emerging markets. So in some sense, India's macro is not as bad as many countries like LATAMs and all. But my hope is that at some point in time, U.S. economy gives in, and that sort of opens up space for uh, our currency to stabilize, and that is when perhaps we'll have sort of sharp rate easing in India coming in. That's how I kind of think how dollar sort of plays through our rate environment and the regulatory macro.
Okay, so that's the dollar strength that we are talking about. The other big thing to watch out for is the union budget, Manish. What do you think is going to be the focus area of the government? Because the mass and the consumption side does need a lot of pickup, but on the other hand, the government has been doing a lot to push up sectors like industrials and manufacturing already.
I think budget this year as well, given the constraints that we have, that the public debt is still sort of significantly higher, 10-12% higher than what it was pre-COVID, and a commitment has been made with respect to tightening fiscal further, along with the path that's been laid out for FRBM. My guess is that you will still see 50 basis point of fiscal sort of consolidation. Now, perhaps you don't need fiscal consolidation. You need some bit of an easing, but there are constraints which apply to us, and as such, global consensus is there to not do fiscal binge anymore. So I think the key takeaway from budget would still be likely a fiscal consolidation, along with of course in certain metals and many other sectors you will need tariff hikes given the kind of dumping which is happening from China and the China manufacturing surplus. So I guess these are the two things to watch for, that what kind of industries get protected by way of tariffs, and second is fiscal consolidation. Um, as such, budget cannot sort of stimulate growth, so the entire onus of actually re-stimulating growth sort of lies with monetary policy. So rate easing of regulatory policies by RBI, and of course letting go of currency. So let the currency weaken. These are the three instruments available to us to actually improve the growth environment. I don't think fiscal is going to do much to it.